Alright, now we're on the very last assignment, so everybody quit smiling, okay? We're looking at partnerships. And the first one is number 2, and Marty Stubbs invests land in a partnership with Lee. He purchased the land for $200,000, and real estate now values it at $500,000. Stubb wants $400,000 in the new partnership, but Dix objects. Dix believes Stubbs' investment should be measured by the book value. They seek advice. Which value do you think is appropriate? Well, what it's invested at, what it is market value, I believe you'll find in the book that market value is what it should be. And that would be the $500,000. So there would be a debit here of $500,000, and Stubbs would have capital. Whichever is most clearly defined is what the value is going to be. Market value is fairly clearly designed. Let's look at number 3. And number 3 is we have 2 people investing into a partnership, and they want us to record their capital. Well, we've got cash of $1 million here. You've got land of $10 million. Again, as you go down through there, land valued at $10 million. And a note payable that has to come over here, they're going to take over, is a $3 million. So let's kind of compare these two. And you've got $11 million total here. You have a $3 million credit. So that means that capital right here, his capital is going to be the difference between the two, which is $8 million. Now we'll move on to the next gentleman. He has $3 million in cash he's going to donate or put into the business, and $7 million in equipment. Must be worth or valued at a $7 million, and that leaves his capital at the sum of these two, so it'd be at $10 million. And then the next question they ask you, you can kind of see, it's like a proprietary ship, only you're putting 2 of them together. The interesting thing about partnerships is when they get the partnership agreements, and you have to start divvying up the net income, and if you dissolve the company, how you will handle managing the capital distribution. So, and then they said compute the partnership's total assets, liabilities, and owner's equity immediately following this. Well, you can fairly well just pull that off, and you'll see what you end up with here. In 4 asks, they have beginning capital balances of $20,000 and $16,000. They've agreed. Let's see, the 2 partners failed to agree on a profit-loss ratio. For the first month, the partnership lost $8,000. They did not agree on something, and they don't have an agreement, which is pretty stupid. So what do we want to do with this this problem? Usually when there is no agreement, it's going to be split 50-50, and that's exactly what you do with this problem. So how much loss goes to Abel and how much goes to Baker? Well, you're going to split it right down the middle, so each one of them is going to get $4,000 loss. And then the partners withdrew no assets during June. What is each partner's capital balance on the 30th? And then they want you to prepare a T accounts, which we've already put here for you. Well, they had a loss, so they're both going to have a negative $4,000 here, which is going to bring their balance down. And then in 5, we have capital balances of $20,000 and $30,000 and $50,000 respectively. And this table is set up to help you learn to disperse partnership net income and capital and all types of expenses that are being designated here. Okay, they have now they have a very good partnership agreement, and what it amounts to is the first $40,000 of profit is divided by the degree or the percent of their capital. So you've got 20,000 over 100,000. The full capital is 100,000, so it's proportioned by their percent. So this is 20%, 30%, and 50% times the 40,000. So that's going to get distributed on the line. There's Lee's, you'll put it in Lee. There's Muses, and this would be Nails. So you'll put the 20% times 40,000 right here. I'll do the first one for you so you can visualize this. And you'll just continue on. So that distributes the 40,000. The second 40,000, we've got 92,000 we're distributing here, is half and half for Lee and Null, because that's how much time they spend. So again, Lee would get half of 40,000, so that's 20,000. And again, you would move that over also for Null here. He would get 20,000. Let's see how this is going to work out. And then whatever's left over, and you can see there's 12,000 left over, is equally split among the three of them. So it's 1/3 of 12,000 is split out. When you get done, there's nothing left to allocate. You'll add up each column and find out how much each partner gets out of this. And it should add up to these if you have it correct. And this is how they distribute. It can get even more complicated than this, but this is fairly complicated as you go. So that is 5. Let's see what 6 is. And 6 is looking at, Ann Todd has a capital balance of 30,000. Carson's balance is 25,000. And Claire pays 100,000 to purchase Carson's interest in the partnership. And Carson gets the full $100,000. So what are they wanting us to do? Let's think about this. Right, now let's read this again very carefully. Carlson's balance is 25,000. Claire is buying from Carlson that amount, but she's paying 100,000 for it. That 100,000 is outside of the partnership. The only thing that's going to be recorded is that $25,000 that comes out of Carlson's and goes into Claire's account, and that admits her as a partner into the partnership. So it acts. Carlson acts as an independent seller in this situation. So the only thing that's going to be recorded is that $25,000. And finally, we come down to 10, and I think probably I need to cut this off because you've been sitting too long, and we'll start up again with 10.